All right, so this is our second class, January 21, 21. And so what we want to do today is do some introductory. We'll probably have to move this, class 3 will be talking about paper 1, so this will probably extend on in the class 4. But the economics of property and casualty insurance, and some of this relates also to other types of insurance, not just property and casualty. But with today, I focus on frequency and severity, and then I want to start this discussion about the capital asset pricing model. Hopefully you've seen that in other classes. You should have seen it in a few classes, especially just 3013 when you started out in your first finance class, and probably have seen it in a couple of others. Actuary majors may not have seen it as often, although most actuaries I know the capital asset pricing model very, very well. So it's good to know. I'm sure it's on the exam, actuarial exams itself. So that's how far I hope to get, and we probably won't finish the capital asset pricing model discussion. You're probably wondering, what does that have to do with property casualty insurance? And so hopefully you'll find it pretty amazing the way we'll actually think about risk in a financial term, and then go back and apply that to the property and casualty insurance industry. All right, so I'm in the class notes on page 2 of the class notes. And so we're going to start with this concept of frequency and severity. Frequency, there's two ways you can think about frequency. One is the probability of loss, the probability that something happens. Insurance companies also think about frequency in terms of how many claims they get. A claim is someone filing, saying they had a loss that's covered by the insurance. So we'll see throughout this class on some of the articles that the term frequency will often be referring to how many claims have been filed. The probability of loss is more of how we think about it as individuals when we're looking at how valuable the insurance is. But the insurance industry or an insurance company thinks about it in terms of how many claims they get. And in severity, we can think of severity for us individually as how much money we can lose. The insurance industry thinks of severity as the average claim. So frequency is the number of claims, severity is the average claim. So it's possible you have an event, maybe a minor ice storm in Dallas. So you have a lot of claims because a lot of cars are damaged, but it's not a serious ice storm, although in Texas any kind of ice can be pretty bad, but the average claim is pretty small. So there you have high frequency, but the severity is not too bad. Or you could have something that happens extremely infrequently. Earthquakes is a good example. There have not been that many earthquake claims over time, but when they happen, the average claim can be quite large. So there's all different kinds of combinations. We are going to use the term expected loss. So it's important to understand, in finance we use the term expected value. Expected value is simply the probability multiplied by each outcome and just tells us the average expected outcome. But in insurance, unlike investing and most of finance and insurance, we're only looking at the downside. We're only looking at claims, losses. So we talk about expected loss, which is the probability of a loss times how bad the loss is, the severity, frequency times severity. So expected loss is frequency times severity. It's also known as the pure premium. The pure premium is the premium an insurance company charges you that just covers the claims itself. It doesn't cover their expenses, doesn't cover their profit requirements. And we'll be talking about that more when we get into pricing at the latter part of the class. So let's get an example. Let's take a 22-year-old male driver driving a red, I say 8-cylinder, just a joke, but the most powerful car you can think of. So from an insurance company standpoint, that's a very dangerous driver. Some of you as male drivers probably know that as soon as you turn 25, your insurance premiums drop dramatically. Why is that? Well, it's because your frequency goes down. Probably your severity as well, but your frequency goes down. Your probability of an accident is very low. But a 22-year-old driver driving a red car, I don't know why red cars have more accidents than other cars, and driving a very powerful car that can go very fast, very quickly, has a pretty high probability of a loss. So we're going to say 1 out of 50 years, they're going to have a massive loss where they're going to total the car. The car's value, let's say, is $50,000, so their expected loss, their pure premium, is 2% times $50,000 or $1,000. The insurance industry has to charge much more than $1,000. So what that means is you as an insured, when you buy insurance, it's a losing transaction on average, because we're going to pay maybe $1,500 for something that on average we expect to get $1,000 back. So we don't think about property casualty insurance or life insurance as being investments because they don't fit that criteria. We're expected on average to lose. So we'll talk a little bit why we still do that. It has to do with this frequency and severity. But insurance is a losing transaction. That's going to be very important. We talked about this some in my last semester. Some of you had my life insurance class. We talked about with health insurance, one of the issues with health insurance is we so overuse it, and you don't want to overuse insurance because it just adds costs. It just makes things more expensive because you have to cover your insurance company's expenses and their profit. So we like to limit it. So let's get into when should we use insurance. So insurance is priced so the policyholder on average loses money. Their expected loss will be less than the cost of the insurance. Why? Because the insurance company has expenses and they have high expenses. Insurance is an inefficient industry, not because they're not diligent and don't try to keep their expenses under control, but it's because they have expenses no one else has. They have actuaries, have underwriters, have investment professionals, have other experts, a lot of lawyers. It's a very expensive business to run, and as a result, they're going to have to charge a lot over and above the expected loss to cover all those expenses. So it's a very inefficient industry. So the question is, when should an individual buy insurance? And we're going to start with frequency and severity. I will later, probably next week, I'll get into this concept of rate online. I don't think I do that. Well, we might do it tonight. So yeah, we'll get into it. I like that concept. It's a really good way to think about insurance, especially auto insurance. I think it works really, really well for auto insurance. But let's start with these factors of frequency and severity. So that's when individuals should buy insurance. The next thing we're going to move to, though, is when, or even more importantly, why should corporations buy insurance? And that is the second part of this discussion, which we're going to bring in the capital asset pricing model and use that to help answer this question of when corporations should buy insurance. And it has to do with this idea of systematic and unsystematic risk. So it really comes down, are insurable events systematic or unsystematic? And we'll get into that. And then we're going to make a very bold statement that according to the capital asset pricing model, corporations really should not be buying insurance. And yet they buy a lot of insurance. There's more than 50% of the insurance market is the commercial side. The side on the corporate side that buys insurance. So then the next part we'll go through is, well, if theory says they shouldn't buy insurance, why do that? Do they do that? And that has to do with other stakeholders in this equation. And then the last thing we'll address is when should insurance companies sell insurance? And that's a good overlap to your paper 1, which is the Warren Buffett annual report. So that's where we're going with economics of insurance. We know it's a losing transaction. Insurance companies are expensive. So we'll look at the individual. When should they buy insurance? We're going to use frequency and severity to answer that question. Then we'll get into corporations. Why should corporations buy insurance when the theory says no? And we'll get into those. We'll get into the theory and then those reasons. And then finally, we'll go to the insurance industry itself and ask, when should they sell insurance? When does it make sense for them? And that will have a high overlap with paper 1. So let's start with that first question. When should individuals purchase insurance? And again, it's going to relate to frequency and severity. So let's think of this in a quadrant. You have low frequency and high frequency. You have low severity and high severity. So let's start with I don't know, top left or bottom right, depending how you put them in the boxes. Let's start with something that's low frequency, doesn't happen very often. And when it happens, it's not all that severe. It's not really going to harm us financially all that much. What does theory say there? The theory says don't buy insurance. Why? Because remember, insurance is priced to lose you money. You're better off just self-insuring those. Just retain the loss. If you're not familiar with the word retention or retain, just keep the loss. Don't try to finance it with an insurance company. So it doesn't make sense to buy insurance for low frequency, low severity events. However, there is insurance for those things, and a lot of people buy this stuff all the time. So warranties on low-cost items is a good example. I don't buy warranties even on expensive items, but I remember I was at an electronics store, and I just wanted a small black and white TV. I don't own a TV, but I just wanted a small one. This before TVs went digital. I just wanted something I could watch the news and maybe a couple of things, but I just didn't watch TV. And so I bought a TV. It was a $16 TV, and I can't remember the exact price, but when I bought the TV, they wanted to sell me a warranty. It was either $7 or $9. I can't remember which, but they wanted to sell me a warranty on this $16 TV, and it would be, let's say it's $9. They wanted me to pay $9 in order to get a warranty on a $16 TV. And I thought the guy was crazy. He kind of laughed about it and said, yeah, it was crazy. And then he still asked me if I wanted it. So he didn't quite understand my sarcasm. But yeah, I told him, yeah, if I walk out of here and drop the TV in the parking lot and completely destroy it, I'll just throw it in the trash, come back in and buy another one. I'm not going to pay $9 for a warranty. It just doesn't make sense. But people do that. People buy warranties. Some of you might want to bring this issue up. I'll definitely let you debate it. We'll have some of our sessions where if you want to bring up this issue of cell phone insurance, I don't believe in cell phone insurance. It just seems grossly overpriced to me. That gets back to the rate online we'll talk about later. It just doesn't make sense, but I know a lot of people buy it. And a lot of people say, I'm sure glad I bought it because I needed it. We'll get into that issue. The simple fact that you used the insurance, does that mean it was really a good deal or not, that you should have done it? So we'll get into that issue. Another way we buy low frequency, low severity insurance is when we pay for towing and labor. Auto insurance, Part D of auto insurance will frequently cover towing and labor. People buy it because it looks so inexpensive, but it's inexpensive because you're highly unlikely to use it. And if you use it, it's not gonna kill you. It's not gonna break your bank. $100, whatever, for towing and labor. And we have to also remember this is towing and labor. It's to get your car to the shop for a covered event. So if your car breaks down with mechanical problems, the towing and labor doesn't cover that. Your car has to be towed because it was in a covered accident under your auto insurance. So it's a pretty rare event. I've had my car towed before, but I've never had a car towed because of a covered event, an accident. I've had one accident where I had to actually use my insurance. Someone hit me, but the car was still drivable. I was able to take it to the shop, so I didn't need towing and labor. So I think the better approach with these is to retain and just use loss control. Find ways to try to limit your need for the insurance. Drive more carefully. Pay attention. There's things we can do to reduce the probability of these things happening. But if you want to debate in class about cell phone insurance or even buying warranties, we can certainly have the debate. But remember, bottom line is when you buy this stuff, you will pay on average more than you will receive. Only the lucky few will actually get back more than they pay in. But let's go to the next category, which is high frequency, but when it happens, it's not all that severe. And here again, we say no, and especially no here, because insurance is priced to losing money, and you're using it all the time, so you're bound to lose a lot of money. At least up here, you're paying more than you expect to get back, but it happens so infrequently it's not very expensive insurance. But this will be expensive insurance. However, many people buy this insurance. So my least favorite insurance, one of my least favorite insurances, is dental cleanings. So dental cleaning maybe costs you $70 twice a year, so it's $140. And if you buy insurance on that, you're probably going to pay $170, $180 for that. Now you might say, well, I don't pay that. And that may be true, but between you and your employer, you're probably paying $180. They give you $140 of cleanings every year. You would be far, far better off if you just walked into the dental office with a credit card and just pay for it. And that's what I do. I just hand them a credit card and say, here's my pay. If you look at the dental office, they'll have a person in there whose their whole job is to handle insurance claims. So it doesn't just add cost to you through your insurance company, it also adds cost to the dental office and their costs go up. So things like that, where we go all the time, we know what the cost is, we can plan for it, we can budget for it. We're going to be far, far better off if we pay for that out of our pocket. Now, I realize dental insurance also covers root canals and other wisdom teeth and those other kind of things. I'm not saying that other insurance is bad. I'm just saying that the dental cleaning part should be taken out of the insurance, and we should just pay for that like we pay for everything else. All it does is raises costs. In my life insurance class, we talked a lot about healthcare checkups, going to the doctor once a year and having insurance pay for that. And again, if the checkup is $100, if you buy insurance to cover that, the insurance is going to charge you $125 for that insurance. You're better off just paying for it out of your pocket. But again, your employer may be subsidizing some of that. So if your employee is subsidizing it, for dental cleanings, if you're paying $100 and your employer is paying $80 and you spend $140 a year on dental cleanings, then yeah, get the insurance. Or tell your employer to stop offering that insurance and just give you the $80 and you'll have more money that way. But it's still, there are some tax reasons and other reasons why some of this economic things do tend to crop up. Then we get to the next one. Now this one is a really wild one. High frequency happens all the time, and when it happens, boy, it's really severe. Now, should you buy insurance here? Well, you should if you can afford it. If for some reason it's mispriced for some reason. But generally, this insurance is going to be far too expensive. You won't be able to afford it. So if you can somehow get through the underwriting and they don't know that you're a high frequency, high severity person and you can get cheap insurance, then do it. They're going to figure out pretty soon and cancel you, but you might be able to get by with it for a while. But it could be something like a very sick person, someone who's maybe only has 6 months to live and they buy life insurance or they buy health insurance. But obviously the insurance company are going to know that and shut that down. Building a house in a floodplain or on the coast, I don't know. I really don't understand why people build extremely expensive houses on the coast. They're almost going to pay for that house twice just by the insurance premiums they're going to pay. So it's just extremely expensive. You're much better off you'd probably be much better off just going down several times a year and staying in a 5-star hotel. Then you don't have to do any house cleaning and you don't have to worry about paying so much for insurance. A 16-year-old driver kind of fits in that category. High frequency, high severity. Most young drivers have something happen during those first few years. And so that can be extremely expensive insurance. I saved my parents a lot of money by waiting until my senior year of high school to get my driver's license. I saved them thousands. I used that to parlay me a new car. That was part of my argument. And then life insurance for people in a war zone. Most life insurance companies, in fact almost all except for USAA, will not sell insurance to someone who's in active military and who's been deployed. They consider it to be too risky to insure those type of people. Those are the kind of things that could happen with high frequency, high severity. Most of the time, you will not be able to afford it. Now, the Affordable Care Act, it has a window of opportunity every year where you can buy health insurance, and you could be really, really sick when you buy it, and they've got to cover you. So your pre-existing conditions cannot be priced against you. That's the same thing with group insurance. You get a new job and they have a health insurance plan. You can get that plan, and if you register during the open window time, there may be a waiting period, but during the open window enrollment, you will be covered even if you had pre-existing conditions. So there are some policies, usually on the group side, when a lot of people will be insured together, where people who already know they're going to use the insurance can actually buy it. But it's pretty rare, and it's somewhat of a challenge. Obviously, the Affordable Care Act tried to get around that by requiring everyone to buy health insurance, and then that part's been kicked out. So it's a challenging bill. It's hard to think about examples of this on the auto and homeowner side, but we might. We'll talk about some of the residual markets that we have on the auto insurance side that might fit in this category, with people with high frequency, high severity can still find affordable insurance. So let's get to the last category, which is low frequency and high severity. Would you buy insurance here? This is what we call catastrophe, and the answer there is absolutely. The low frequency helps keep the cost of insurance low because they're not processing so many claims. But then you want to be covered for high severity, and that has to do with the issue of we are risk adverse people. We're willing to pay $1,000 to eliminate a risk that on average would only cost us $800. Sure, we can insure ourselves. We can put that $1,000 away ourselves, and then when we have that $10,000 loss, hopefully we've had 10 years to save that up. But the $10,000 loss could happen tomorrow, and we haven't saved up anything yet. And so most people, they're risk adverse, and so they would prefer not to be exposed to that high severity event. They buy the insurance, and because it's low frequency, the insurance is inexpensive. So I want to talk here a little bit about Rate Online and show you one of the spreadsheets, a real easy, simple spreadsheet I have on Blackboard. So these are actual numbers from my policy. And what I wanted to do is ask them, this is an auto policy, auto insurance policy. So we'll learn about this. This is Part D of my auto policy. So this is only covering collision and damage to the car. It's not Part A, which is the liability coverage. This is just Part D. And so the decision is, what deductible do I get? Do I get a $100 deductible, a $500 deductible, or a $1,000 deductible? Here's the premiums, and here's the additional coverage I get. So going from a $1,000 deductible to $500, I get an additional $500 coverage, and that cost me an extra $46. Now, if I go from $500 to $100, I get an extra $400 of coverage, but that's going to cost me $140, or $139.80. And so what the Rate Online says is, how much additional premium are you paying for the additional coverage? So we're taking an additional 46 cents versus $500. I'm only paying 9% of my additional coverage. But if I go from 500 to 100, I'm paying a third of that difference. So that means in 3 years, if you haven't had an accident, you're going to be worse off having gotten that $100 deductible. Here, with the $500 deductible, if you have an accident, a serious accident in the next 10 years, you'll come out ahead. This looks pretty reasonable to me. I do have $1,000 deductibles, but I think a $500 deductible makes sense. To me, a $100 deductible does not make sense. You're paying so much. So you're getting $400 in coverage, but you're paying one-third of that in premiums to get that. That's an expensive policy. So this is the concept of Rate Online. It's a good way to think about insurance. How much more do you have to pay for that additional dollar of coverage? And so to go from $1,000 to $500, you're only paying 9 cents for every dollar of coverage. Go from $500 to $100, you're paying 35 cents for every extra dollar of coverage. All right, so that's the concept of Rate Online. All right, so if you're going to buy insurance, you want to limit your insurance purchases to low frequency, high severity events. Now that may be differently defined for everyone. What I consider low frequency and especially high severity might be very different than what you consider. to be high severity. Some people might actually think that towing and labor is high severity because it could be 100, 150 bucks. For me, I don't, I'm in a point in my economic life that, 150 bucks is no big deal. But for some people, that might be a big deal. So if you want to pay that extra, 20, 30 bucks a year or whatever, 10 bucks a year for towing and labor, that's fine. Over time, you'll end up paying more in the premium than you'll probably receive. But if a $150 bill from a towing and labor is an issue, then maybe you buy it. But do remember, if your car breaks down, you're still going to have to pay for that towing and labor. Your insurance won't pay for it, even if you have the insurance, because it's only going to cover covered events. So we want to limit ourselves to low frequency, high severity events. It's insurance that's affordable because of the low frequency. It protects us in the things that we're most worried about, those things that can really wipe us out. And we can somewhat gauge what we're paying for by looking at the rate online. So when I move from a $100 deductible to a $1,000 deductible, I'm greatly reducing the frequency. I'll be filing far fewer claims because with a $100 deductible, small fender benders will go to my insurance. But if a $1,000 deductible, I might not even bother to take the car in. I'm just no big deal, just leave it there. Or I'll go in and get it fixed, but I'll just pay for it out of pocket. So that's how individuals should think about insurance. I will encourage you to think about this with your own insurance. We'll get into a debate. No question we'll have a debate. I always lose the debate about parts B and C of auto insurance. I don't buy it. I don't think it's worth it. I think it's mispriced. I think it's a horrible insurance. I give all my arguments every time I do this class, and at the end, 70-80% of the class disagrees with me, and they still buy B and C. I'm going to try to beef up that debate. This semester, I have some alums, UTSA alums, that work for the insurance industry, and I'm sure they will strongly argue that people should buy B and C. But when I argue against an insurance, I'm using these arguments: frequency, severity, and rate online, to make that decision whether or not I should be purchasing insurance. All right, so there's individuals. Now let's move to corporations. Before we do that, let's do a little bit of review of the capital asset pricing model. The capital asset pricing model was developed by William Sharpe back in the early 60s. He won a Nobel Prize in economics for this. Very sharp man, very quantitative. He essentially was the genesis, essentially his theories for the indexing mutual funds and exchange traded funds. He also was a big proponent of the use of computers in finance. Right now, what he's working on is retirement accounts, helping people as they move from working to retirement, how to take the money out of the retirement account. So he's had his hands in a whole lot of different things. But this is the theory he came up with. If you want to see his website, you can certainly go there. So here's a list of all of his articles. Some of them are pretty unreadable because they're quite technical. Some of them are very readable. He doesn't have an actual article on the capital asset pricing model itself. I've always been tempted to go and find his original dissertation paper that he published because it's one of the most referenced papers in all of finance. He does have articles that hit on CAPM and what it means, but some interesting articles. The Sharpe ratio is definitely related to the CAPM. So there is a lot of CAPM going to be in these different discussions, but interesting guy. This page hasn't changed much. You can see some of these articles are pretty old, so he's not adding a lot of writing. I don't think he's writing articles as much as he used to. So let's get into CAPM. What do you remember about CAPM? If you are a finance major, you should be an expert on this. You should know it backwards and forwards. Let's start with what it stands for. It stands for the Capital Asset Pricing Model. I think that's a terrible term. They say capital asset. I'm going to take this word equity out. We don't need that. But capital asset, that's not really true. I've only seen the CAPM used with stocks. It's not used with all capital assets like bonds and real estate. That's the reason I had the word equity in there struck out. Equity is both stocks and real estate. It just represents ownership, but not even equity. It's only stocks is what I've seen it applied to. So the capital asset, I think, is a little stretched. I think when he initially wrote his paper, he did intend for it to be all capital assets, not just stocks, but it really doesn't apply to some other assets like bonds. He calls it a pricing model, but it doesn't actually provide a price. All it does is provides a discount rate so that you can calculate a price. So even pricing is not quite correct. And then he calls it a model, but I don't really think it's a model. It's just a formula. It's a very simple formula. It's the cost of equity capital. I say the word equity there, but again, I'm talking about stocks. I'm not talking about equity. Equity capital of an individual company. We call it KE for cost of equity. And it equals the risk-free rate plus beta times the market risk premium. So the risk-free rate, so this is the discount rate you use to value any stock out there. The risk-free rate and the market risk premium, we're not going to talk about in this class. You should have them in other classes, but they're the same for whatever, any company you value, you would use the same risk-free rate and probably the same market risk premium. It could vary a little bit if it's a large stock or a small stock or what country you're in. But for the most part, your risk-free rate and market risk premium will be the same number for all the stocks that you're valuing. So where the discount rate changes for individual stocks is this term beta. Beta is how we change our discount rate to reflect the individual risk of a stock. So let's get a definition of beta here. So it's an extremely important concept. You could certainly look it up in Wikipedia if you want to get some more background on it. But it's a measure of, and this word relative is extremely important. It's a measure of relative, non-diversifiable, or also known as systematic risk. Relative to what? Relative to the market. And the market really should be, if you go back to the original thought, it's every asset on the planet. Then if you're only going to apply it to stocks, then it should be applied relative to every stock in the world. But traditionally, when you see a beta, it's not against all the stocks in the world or even all the stocks in the US. It's against the S&P 500. So the S&P 500 stock index, even though it's only 500 stocks and it's the largest stocks, beta has always been associated with that. Anytime you see a beta reported in the press, it's always against the S&P 500. So it's relative. Why do we say relative? Well, the beta of the market is 1. So we're just looking to see what non-diversifiable systematic risk this company has relative to the market, so we can adjust their discount rate to reflect whether they have higher or lower systematic risk than the typical stock in the market. So if Google's beta is, say, 1.4, we're going to say that they have 40% more systematic risk than the market. So the question is then, what is systematic risk? And if we have systematic risk, what is unsystematic risk? Well, total risk, we usually measure that with standard deviation, but total risk is a combination of systematic and unsystematic risk. Some of the total risk of a stock is systematic, where beta is going to pick that up. Some of the risk of the stock is unsystematic, which beta completely ignores. A pretty amazing thing. So let's define these, because these are going to be really important. We're setting up an exam question on exam 1, which a lot of students do really poorly on. And I think it's maybe because at this point in the class, students are not really that focused. So get really focused, because this is an exam question and you need to be able to fully explain this. It's a great question because not only does it help us understand property and casualty insurance, it also brings back this important concept of finance, gives you another chance to apply it and learn it and let it really sink in, because it's an important concept to understand. So systematic risk versus unsystematic risk. Systematic risk, you cannot reduce systematic risk by diversifying your portfolio, by just adding more stocks. That doesn't work, because systematic risk is inherent in all stocks. The best way to think about a systematic risk is just to think about the economy. So all stocks are exposed to economies going into recessions, but some stocks are more exposed than others. So good way to think about the beta of your company is assume the economy goes into recession. Is the stock of your company, or is your company that you're looking at, that you're assessing, is that company going to perform worse than the average company in the market, or is it perform better? So let's take some examples. Let's think about Ford and, well, let's do Costco. So we go into a recession. How's Ford going to do in a recession? Well, they're going to do a lot worse than the average stock. Because people in a recession are losing their jobs, they're definitely not going to be buying brand new cars. So Ford would have a high beta. It's what we call a cyclical company with high beta. So maybe their beta is 1.8. And then you look at Costco. Well, Costco in a recession, they may actually get extra business during a recession. If people are losing their jobs, they're worried about spending. That's going to affect them negatively in some places, but in some places, people might actually shop more at Costco because they're worried about the economy. They want to save money. It's a discount store, so we call it an offensive stock with a low beta. And Costco is definitely a low beta, maybe 0.6 or even lower, maybe 0.5. Why? Because it's just not that sensitive to the overall economy. It does have systematic risk. I'm not saying Costco does great during a recession, although we did see Walmart's another good example. Walmart did extremely well in the 2008 recession. They did very well in the COVID-19 recession of 2020. So some of these stocks actually do fairly well in certain types of recessions. It really depends on the type of recession. But Costco is a defensive stock, so it's going to have a low beta. There are other systematic risks, and this is going to be important to our discussion about why corporations buy insurance. But interest rates, inflations, the stock market itself. CAPM is a one-factor model where they say the market itself can explain all of these other factors. It's going to tell you about the economy, the interest rates, inflation. I think that's one reason why CAPM doesn't always work so well. Why betas are so unstable is because there are different systematic factors hitting different industries at different times. Commodity prices are important systematic factors. Demographics are important. So there's a lot of factors that hit all stocks, but just not equally. Obviously, bank stocks are going to be more hit by interest rates than, say, maybe a discount store. Inflation is going to hit certain markets more than others. Commodity prices, obviously, airlines are going to be hit by jet fuel prices. So you have all these different inputs. When you put them all together in this one-factor model, we're trying to ask, will this firm react more negatively than the typical company out there during bad news or bad times, or will it act defensively? So beta is not a number that you look up in Yahoo Finance. It's a forecast. If you look up in Yahoo Finance, that's just telling you what their actual statistical number was the last 5 years. Betas are terribly unstable, so if you look up a beta in Yahoo Finance, you might get pretty wild numbers. And just to give you an example, so here's Ford Motor Company. And you can see their beta is reported at 1.28. That is way too low for Ford. Not only is it too low for an auto manufacturer, but Ford has a lot of debt. They're a very levered firm. And obviously they've done really badly during COVID-19. So 128 is much too low. We definitely use 1.6, 1.7, 1.8. Now what if we look at Costco? So Costco, we would expect a much lower beta. Their actual beta, they show us 0.67. That's a little high. I would probably go down to 0.6 or 0.5 for them. A little bit high. They've done really well in this recession. They're making really high earnings, and their stock price is at a close to an all-time high, even with the recession. So they did, here's coming out of the COVID-19, you can see how they've done extremely well. So they're not quite at all-time highs, but they're doing really well. And so when you look up a beta in Yahoo Finance, they're using monthly data just back 5 years. If you're actually, some of you have had me in other classes where I do rolling betas, and you'll see just how unstable they are. You'll see Costco's beta of above 1 at sometimes and down to negative even sometimes. I've seen Walmart. I don't know where Walmart is right now, but I've seen Walmart's beta negative, and I would definitely not use a negative beta for Walmart. Right now, it's a little low. I think Walmart's beta should be higher than Costco's. So, when you use Yahoo Finance, you're just getting one statistical, it's like one sample, a sample size of one. And you really need to look at it much broader than that, and even think of it as a forecast. What do you think this firm is? Is it cyclical? Is it defensive? How defensive is it? How cyclical is it? So be careful. Betas are very unstable, much more than the theory allows. And because of that, betas should be much more of a forecast than something you just a number you pull out of Yahoo Finance. Although I think the majority of finance students, undergraduate finance students, even graduate finance students, they get their betas by just going to Yahoo Finance, and you just get what we call regression betas. So the only way you can reduce systematic risk is to take less of it. It's to add lower beta stocks to your portfolio. If you want to reduce your risk of your portfolio, go out and find grocery stores and Costco's, and those type of businesses, maybe pharmaceuticals, maybe utilities, those businesses that will do well in a recession, and that will reduce the systematic risk of your portfolio. You will not reduce systematic risk or randomly throwing 50 random stocks into your portfolio. It would all depend on what the betas of those stocks are. If you did it random, your expected beta would be right at 1. So you really would not, it's just not the way to address it. So that's systematic risk. Now let's talk about unsystemic or unsystematic risk. Unsystematic risk is firm specific. It could be industry specific. It's diversifiable, and it's what we call idiosyncratic. That's the word I use if I'm in an interview, is idiosyncratic risk. Those risks that are specific to that security. And what the capital asset pricing model says is you can easily eliminate this risk by simply diversifying your portfolio. Just add more stocks to your portfolio. It doesn't really matter which stocks you add. It can be any stocks. You probably need them from different industries, so you don't get a lot of exposure to one particular industry. So you don't want to just add 20 tech stocks to your portfolio. But if you randomly pick stocks, any 20 stocks, your unsystematic risk will come down. And this is a really key word. You should probably put this in your exam answer. Unsystematic risk can be eliminated, not just reduced, but completely eliminated through diversification. If you have 20 or so stocks from several different industries, your unsystematic risk will most likely be close to 0. All right, so this is really key. We're setting up this discussion about property and casualty insurance. You do need to, in your answer, to give me a definition and discussion of capital asset pricing model. I do need all of that intro. And then where most students miss it is the definition of CAPM, that link of that to the discussion about property and casualty. You got to get that link. So we'll talk about that here in a little bit. But unsystematic risks, the stock market says, according to CAPM, you as a stock investor can ignore that risk because you can easily get rid of it by simply diversifying your portfolio. And because of that, CAPM says investors do not get paid a risk premium. They do not get paid any compensation for taking on unsystematic risk. If you decide to put your entire portfolio in Ford, and boy, that's going to be really volatile. Your stock portfolio is going to go really up and down pretty dramatically. And you look at that and say, wow, Ford should be giving me a 70% return. And you look at Ford and their price to give you maybe an 8% return. Say, why in the world would I buy this stock? It's so volatile. Well, the market says the reason people buy Ford stock when it's only expected to give you an 8% return is because a lot of that risk of Ford is eliminated when you add more stocks to your portfolio. So that word eliminated is really, really, really key. So your discount rate will not reflect, your broker will not let you use a discount rate that will reflect your risk for unsystematic events if you do not have a diversified portfolio. You call your broker and you say you want to buy I don't know, Apple stock for $3, and it's trading for much more than that, and you tell your broker, well, it's because my discount rate for Apple is 62%, because boy, it's a really risky stock. Your broker is going to say, well, no one's using that high of a discount rate, because most people know a lot of the risk of Apple gets eliminated when you add other stocks to your portfolio. Unsystematic risk, most students are surprised by this, but unsystematic risk is generally 75 to 85% of the risk of a particular stock. So most of the risk of companies is actually unsystematic. Only 15 to 25% of the risk of an individual company is actually market-driven systematic risk. That's pretty important too. That's pretty amazing, because that means when you have a diversified portfolio, you're eliminating 70, 80% of your risk by simply diversifying your portfolio. Pretty amazing. Now, this is the other thing where a firm like HEB or Facebook, before they went public, this is a reason a lot of firms go public. Because if you're not public, if you're one of the Butt family and you own HEB, and this firm HEB is not public, that means your discount rate, when you value HEB to you, your discount rate is going to be very high, because you cannot eliminate your own systematic risk. You're stuck with HEB. It's a big part of your portfolio. Whatever happens to HEB is going to hit your portfolio. You don't have just 2% in HEB. You might have 80, 90% of your wealth in HEB. And because of that, the value of HEB to you is going to be really small. The second HEB goes public and can become part of a well-diversified portfolio of stocks, that discount rate would drop dramatically, and you, as a member of the Butt family, your wealth might go from $300 million to $3 billion overnight, just because you go public. That's the reason so many firms go public, because when you go public, you now take 70, 80% of the risk of your company, you diversify it away, you now get a much lower discount rate to use, and now you can sell your HEB stock into the market where you have diversified investors, much lower discount rates, and the value of HEB is going to be much higher. And that's really why, I get the impression that Facebook really didn't want to go public, but you almost have no choice. If it's your net worth is a difference between $5 billion and $50 billion, you're probably going to go public, so you can get that unsystematic risk diversification benefit on your discount rate. So beta is a measure of relative systematic risk. Its formula is covariance divided by the standard deviation of the market squared. In Excel, it's the slope function, where you do your company's returns versus the market returns. It's an unbounded statistic. Unlike correlation, correlation has to be between -1 and 1. A beta can be anything. It can be -5 million, and it can be +5 million. Most stock betas range between 0.3 and 3, but there's no limit on betas. Betas can be very high and very low. Covariance, if you think about, now here's the formula for correlation: covariance divided by the standard deviation of the market times the standard deviation of individual stock. So you see in correlation, you have both the market and the stock. With beta, you only have the market in your denominator. If you think about covariance, very important formula. You just take, if you've got 60 pieces of data, you take the average of those 60, and then for each data point, you take each individual one minus the average, and then you compare that to say the market, its individual minus its average. And what you're looking for with covariance is you're comparing two different things. Here with beta, we're comparing the market to an individual stock. We're just asking the question, when the market's above average in its return, is this particular stock having an above average month? When the market's below average in a month, does this stock below average? If you're above average at the same time and below average at the same time, you're going to have a very high covariance. If one's above when the other one's below, or one's below when the other one's above, that's going to give you a lot of negative numbers, and your covariance will be very negative, and that will give you a very low beta and even a negative beta. Don't forget these formulas. You should know them off the top of your head. They're really, really important formulas. But correlation and beta are very closely linked. There's only that slight difference. The denominator only includes the market, which is what we're saying beta measures. It's that systematic market risk. All right, so here's the link. We're going to introduce it tonight, and we'll finish this up in class 4. What in the world does this have to do with insurance? So in your exam, you've explained all of this stuff. You've proven to me that you understand capital asset pricing model, you understand what beta is measuring, you understand systematic risk, you understand unsystematic risk. Now you've got your next thing in your answer should be, what does this have to do with insurance? So the big question with insurance for corporations is, does insurance cover systematic risk, or does it cover unsystematic risk? And most of the risks covered by the insurance industry are unsystematic risk. It's things like a fire, or one of your trucks has an accident, a worker slips and falls and has an accident. Now, we'll talk workers' comp. Workers' comp does have a systematic aspect to it. We'll talk about that. But most insurance is unsystematic. All right, so that by itself, insurance covers a risk that we just set up above. The stock market can eliminate that risk simply by diversifying their portfolio. So we just, with CAPM as just said, if you have a risk at a company that's unsystematic, there's no reason for management to spend money to eliminate that risk, because the stock market's already eliminated it by holding a diversified portfolio. But there are some systematic risks that insurance covers. So D&O, that's directors and officers. You're going to see this in the first paper. Their errors. You also see E&O, errors and omission insurance. So we're talking here is you're a director on a board and you make a really horrible decision and you get sued personally. D&O insurance will cover you. So why is that a systematic risk? Well, director and officer insurance claims go up dramatically during stock sell-offs. People tend not to sue boards when the stock market's going up. And now, if one company's going down and the rest of the market's going up, then yeah, there may be a lawsuit there. That wouldn't be systematic. That would be an unsystematic risk. But if the whole stock market's falling and now the stockholders are going to sue management because they're losing money on their stock, they thought they made bad decisions, there is a relationship between D&O insurance and systematic events like the stock market. You'll see a direct discussion of this in the Warren Buffett article. So we'll definitely see that. Terrorism risk could be systematic. We certainly saw after 9/11 that caused the entire stock market to drop, had a pretty heavy impact. COVID-19 is a systematic risk. We'll talk about whether COVID-19 was covered by the insurance industry. That's actually a paper topic that you could cover, and I've had some really good papers on that topic. So there are some. So does that mean there is insurance companies should buy insurance for? Corporations should buy insurance. Is there risk? I'm sorry, are there risks? So I'm going to argue even when insurance is covering something that has a systematic aspect to it. So let me talk about workers' comp. Workers' comp can be somewhat, not entirely, but somewhat systematic. And why is that? Well, workers' comp covers you. We'll talk about workers' comp. It covers you, or it covers your employees for accidents on the job. What we know is when the economy is going into recession, there are some workers, a good number of workers, who intentionally harm themselves at work so that they can go on the workers' comp, get disability, and they would rather be home on disability than be laid off from their job. And so workers' comp claims do go up during recessions because of that one issue. Workers tend to have more fraudulent claims right before recession so that they can get get that coverage. All right, so does that now mean there's a place for insurance? Well, I'm going to make the argument, even if the risks are systematic, insurance does not make sense. Theoretically, it's still a waste of money. For unsystematic, we've already said why. The stockholder says we can eliminate that ourselves through diversification. Why spend money to eliminate a risk we can eliminate ourselves? But why am I saying that for systematic risk? And this is gonna blow your mind, but we're going to talk through this. We'll save this for next class. But if you have a portfolio of stocks that's well diversified, so let's say you have 100 stocks in your stock portfolio, such that you own both the company that's being insured and the insurance company, I'm going to tell you that the corporation buying insurance, there's no way your stock portfolio can come out ahead on that scenario. I'm going to show you actually an Excel spreadsheet to demonstrate that. So we'll start here next class. I don't want to go much over an hour on these classes, but think through this. I'd encourage you, now that you've watched this, to sit down and try to draft out your answer, maybe even call me on it, to talk through it. You know, you can call me anytime. I'm on a bike in the mornings, so you can just call me during the mornings and quiz me on your answer here. If you're not comfortable with the capital asset pricing model, then that's wonderful, because now I've given you an excuse to go back and learn something you should have already had before. If you are comfortable with it, then be really, really clear on what this theory is saying for why corporations should not buy insurance. It's a pretty tough essay question on the first exam. A lot of students do very, very poorly on it, getting maybe 20–30% credit because they're just way too high level. I want a very meaty, detailed, very well thought out answer on this. So I do want it. I do want a very, very in-depth, comprehensive question. I don't like high level, shallow answers. So think about that, look at it, start writing out your answer, start thinking about it now while it's fresh in your mind rather than waiting until the exam. Go ahead and write your answer out now so you have it and you can test it with me and it doesn't become a thing you do at the last second before the exam.